Hello everyone. Welcome back to the Lost Messages Mediacast show. A few days ago, we analyzed the financial reports of Chinese banks this year and discovered a critical issue. Even state-owned banks are struggling to make money domestically and are forced to seek profits overseas. The situation is even worse for joint stock banks, city commercial banks, and rural commercial banks, pushing them to the brink of survival. If this trend continues, the future of China's banking industry may see only a few state-owned banks barely holding on, reminiscent of the Mao Zedong era. However, the financial industry is not limited to banks. Other sectors such as funds, insurance, securities, and trusts, do these institutions face the same fate? Surprisingly, yes. Recently, many domestic public fund companies have been selling their shares, but there are no buyers. Public fund licenses, once a scarce resource in the financial industry, are now seemingly worthless. Is it because these fund companies are ineffective, or has the entire industry's survival logic changed? Is the collective selling of shares by public funds a sign of an impending crisis? In this episode, the Lost Messages will clarify this issue for you. Turning to today's topic, according to the latest report from First Financial, an unusual phenomenon has emerged in China's public fund industry. A batch of mid-sized fund companies has begun to list and sell their equity in large numbers. The sellers have complex backgrounds and are not just small private institutions struggling to survive, but also state-owned, securities firm-backed, and foreign-invested fund companies selling their shares. A classic example is Debon Fund, which is now listing the transfer of 20% of its shares held by its second-largest shareholder, Zhejiang Tuxu, at a low price of 128 million yuan. Zhejiang Tuxu is not an ordinary enterprise. Behind it is the Zhejiang International Trade Group, a typical state-owned enterprise system. This means that even state-owned shareholders are choosing to exit public fund licenses, a valuable asset. Moreover, this portion of equity was listed for sale, last June, at a price of 142 million yuan. And this time it was voluntarily reduced by 10%, indicating that the company is eager to unload its burden. Notably, Debon Fund's net profit for the full year of 2024 is still 13.32 million yuan. The company's poor management became evident when, by the first 5 months of 2025, it had already incurred a loss of 11.23 million yuan. This situation led shareholders to seek ways to cut their losses. Considering the case of Zhonghai Fund, the issue becomes even clearer. Recently, the second-largest shareholder, Guolian Zhongsheng Securities, and the third-largest shareholder, French bank Edmond de Rothschild, jointly listed all their shares for sale, totaling 58.4%, with a combined price of 267 million yuan. The two major shareholders are selling their stakes together, implying that any buyer would have to acquire all their shares at once, essentially taking over control of the company. Guolian Zhongsheng Securities represents securities firm capital, while the French bank stands for foreign invested institutions. Therefore, whether it's state-owned securities firms or foreign capital, they are all withdrawing from the public fund sector. Zhonghai Fund is also facing a serious operational crisis. Established in 2024, the company's assets under management were less than 10 billion yuan, as of the first quarter of this year, ranking 128th among the 164 fund companies in China. The net profit for the full year of 2024 was a mere 3.65 million yuan, and it has likely been in the red for the past 2 years. If Debang Fund and Zhonghai Fund are considered somewhat fortunate, the next example, Huaqing Future Fund, more starkly reveals the harsh reality of the industry. In November of last year, its largest shareholder, Huaqing Trust, listed 40% of its shares for sale at an initial price of 17.2 million yuan, but there were no takers. By the end of December, it relisted the shares at a reduced price of 4.8 million yuan, a discount of nearly threefold. However, as of the end of January this year, there were still no bidders. The seller, Huaqing Trust, is itself a financial capital entity within the trust system, not a small, ordinary shareholder. This indicates that even within the financial system, there is a lack of interest. Trust capital companies are unwilling to continue holding these mini public fund licenses. Even worse, in the first quarter of this year, the Huacheng Neo Fund transferred its last remaining product to the Fuguang Fund. Now, this company is essentially left with nothing but a license. The cases of these three public fund companies show that fund companies, regardless of their shareholders' backgrounds, state-owned, securities firms, or foreign trusts, are all choosing to sell their shares. This industry is genuinely struggling. Just a few years ago, public fund licenses were widely recognized as scarce resources in the financial circle, often referred to as the golden ticket. With this license, one could easily collect management fees, making it a highly profitable venture, as described by the saying a good deal. However, how did the situation change so quickly? The reason is quite simple. The value of a license lies in the stable profits it can generate. In the past, public fund licenses were in high demand because, during economic upswings, asset prices generally rose. Ordinary people were willing to invest their money with fund companies, and banks were eager to sell fund products. As a result, fund sizes grew larger, and management fees flowed in steadily. At that time, anyone who could obtain a public fund license could create various products, secure a few sales channels, and simply wait for the money to roll in. That was the value of the license back then. However, public fund licenses no longer have the same magical appeal. First, the economic fundamentals have changed. Asset returns have decreased, corporate profits are stagnant, and many industries are facing intense competition. The stock market's profitability has diminished, and ordinary people are burdened by mortgages, struggling to maintain their middle-class status. Financial institutions essentially rely on the benefits brought by economic expansion and asset appreciation. Once the underlying returns decline, the first to feel the pressure are the fund companies. Brokerage trusts and other financial institutions that rely on managing money for profit were mentioned in a first financial report. For instance, Debon Fund reported a net profit of 13.32 million yuan for 2024, but by the first 5 months of 2025, it had already incurred a loss of 11.23 million yuan. Costco Fund's net profit for the entire year of 2024 was a mere 3.65 million yuan, indicating that even profits are becoming unstable. This trend suggests that the industry's outlook has significantly deteriorated. Investor sentiment has shifted. Previously, people were willing to buy funds because they believed in long-term investment and the upward trajectory of the Chinese economy. However, current pessimism has led investors to worry about job security, making them more conservative and less willing to invest in risky markets or entrust their money to smaller funds. The value of public fund licenses ultimately depends on continuous capital inflows. Without sustained subscriptions and scale growth, the license is merely a qualification that cannot generate profits. The industry is experiencing severe fragmentation. As of the end of last year, out of the 167 fund companies nationwide, 101 had assets under management of less than 100 billion yuan, accounting for over 60%. However, the combined assets under management of these 101 institutions amounted to only 2.73 trillion yuan, nearly equivalent to the 2.57 trillion yuan managed by a single fund company, E-Fund. This statistic speaks volumes. The public fund industry is facing the same issues as the banking sector, with resources concentrating in top-tier institutions. Smaller firms are struggling to secure market share. This is because the overall market has shrunk, leaving even large institutions struggling to thrive, let alone smaller ones. Public fund companies are not without their own rescue plans. This time, the regulatory authorities have specifically pointed out a potential solution: real estate investment trusts, or REITs. Given China's current macroeconomic backdrop, this appears to be one of the most suitable avenues for publicly offered funds to transition. Given that traditional business markets have shrunk, if these funds can shift towards REITs to invest in stable cash flow infrastructure, real estate and energy projects, it seems there could be a new path forward. From the government's perspective, this is also a welcome development. It helps publicly offered funds find new business growth points while also directing social funds towards real assets, activating existing assets, a true win-win. However, this path ultimately did not materialize. The biggest obstacle remains insufficient liquidity. Why is there insufficient liquidity? Because the market's investor structure is too homogeneous. Data from China International Capital Corporation shows that by the end of 2025, institutional investors' share in publicly offered REITs averages 97.21%. The number of holders has decreased, while the average holdings per account have increased. This indicates that the market is becoming increasingly concentrated in the hands of a few institutions, with low participation from ordinary investors. A continuous buying and selling base and active trading have not been established. What does this mean? The REIT products in China have been designed by the government for internal circulation. The underlying assets are all within the state-owned system, such as municipal investment projects, central enterprise projects, and state-owned enterprise projects. The funds are also provided by institutions, many of which have state-owned backgrounds, including securities firms and insurance companies. Even Social Security and pension funds have low participation. Why can't the emperor maneuver this? The stock market also needs Social Security and pension funds to provide a safety net. Where will the money come from to support REIT products? Of course, the stock market is more urgent. Originally, the emperor's plan was for REIT products to attract risk-averse citizens. However, citizens are genuinely afraid. Not only do they dare not invest in shares, but they also do not want to buy REIT products. Their risk preference is extremely low.